Well, welcome everybody. We're on our way to finishing the course. We have this week yet, which we're going to be talking about chapter 12 and finishing that up. Our exam, I'm going to extend this to May 1st for our chapter exam, continue on that Wednesday schedule for the exam due dates. In fact, why don't I just quick change that? That won't take that long. Next week will be our final discussion week. Can you believe that? On chapter 15. And that chapter is a short chapter. So a normal class, would run till at least 8 discussion-wise. We're looking at an hour, hour and a half maybe at most. So if you wish to collaborate next week, because it's such a shortened class period, I don't want you running here for an hour or so and then that's the end of the discussion. So if you wanted to collaborate next week, it might be a good day to do that. Obviously, the tests can be taken right away after the class. We are not scheduled to meet on May 7th. I will be here though. So if you wanted to come in and take the exam, you certainly still can. I will be here on May 7th. And then obviously May 14th I will not be here because we'll be all wrapped up by that time. So keep that in mind, work that in your schedules, work schedule and school schedules and so forth. So for sure I will be here next week, obviously to do the 15 chapter. And then the following week, the 7th, I will be here also, if you wish to take the exam on that night. There won't be any discussion, obviously. So, for tonight, we'll cover our Chapter 12 discussion. I did send out an email, if you could bring your financial calculator, because we can do basically the net present value computations on our financial calculator. If you don't have one, you can borrow mine tonight if you don't have one here. So we'll get to there shortly. I did send out an email, right? Okay. So hopefully you got that. If not, we'll work with it. Chapter 12 begins on page 645, and it revolves around capital investments. The company profile is Hard Rock Cafe, and they use some of these analysis tools to help them make a decision where to open up a new Hard Rock Cafe. So if you get a moment, take a look at that overview. Gives you some good background information. I also did something, just some little tidbit stuff. If you're looking for a goal for yourself, here's a guy that for 30, 40 years has eaten 30,000 Big Macs. He's 64 and he's still alive. So I just wanted to mention that, just some tidbit information on McDonald's. But the real reason I brought McDonald's up is that they feed on a daily basis about 70 million people, and they sell 75 hamburgers every second of the day, which seems like so much, doesn't it? And they don't make their money on food. They make their money on real estate. And the concept here is pretty straightforward. They own the land that the McDonald's properties sit on. Only 5% of them are owned by the company, and then the rest are leased. So they lease out the property, they charge the franchisee a $45,000 upfront, and then they get 4% on their gross sales. And that's what they make their money on, is that basically lease part of the. And it talks about that, and that's why I'm introducing it in this chapter, is because they're into property management basically and capital investment. So their revenues generate, what is it, 27.4 billion, with 9.2 coming from the franchise, 18 company from company-owned leases. So, but anyway, hopefully that gives you some background information. All right, so our goal in tonight's discussion is to help us determine if we should make a capital investment in our company. Is it worth the expense or the cost of buying this capital investment? And will it be a good, profitable decision for our company? When we're talking about capital investments, we're looking at buildings, we're looking at equipment that we use in our operation. And there's some terminology, again, that we're going to have to work through to get through Chapter 12. And it starts with this independent versus dependent projects. This is on page 646 of our book. This is used on our multiple choice questions. An independent project is, I can accept or reject a project. It has no effect on another. They're independent from each other. As opposed to mutually exclusive, if I pick one project, we're not doing the other. So a lot of small companies, because of the cash flow problems, kind of fall in this category because there's simply not enough money to go around, right? Simply don't have the resources to do every project that we want to. So please know the difference between those two terms. So our next task is, how do we make a good capital investment? What are we looking for? Remember, we're trying to earn back our capital outlay as well as provide a reasonable return on the investment. We don't invest in a company just to have it returned to us. We want to make some kind of profit on it, right? So that's the goal here when we're looking at these projects. So we will be given a company desired rate of return. Every problem will have this information, especially the discounted ones that we're going to be covering. And that's where we're going to use our calculator to come up with that desired rate of return. So to get that to that point, we got to estimate. We have to estimate the cash flow timings. We have to assess the risk that are associated with that timing of cash flow, because there's a lot of unknown. If we're looking at a capital investment, we're looking forward 5, 10, 20 years. So there's a lot of unknowns there. And we have to be concerned about that rate of return for our company, the profit aspect of it. Will this equipment investment generate some profit for our company? And this is all discussed on page 647. (648) then has us look at two different types of models for choosing a good project to invest in. The first one are non-discounting, and all that means is that we ignore the time value of money, and the other model is discounting. So I want to just write down the time value of money. Does anybody have a definition here for time value of money? What does that mean? Pardon? Anybody? Time value of money?
To pay money back? No.
No, it's actually $1 today is worth more than $1 tomorrow. $1 today is worth more than $1 tomorrow. Think about it. I'd rather have $1 in my pocket now than maybe $1 a year from now. Because, remember, there's risk that we have to deal with, right? I might not get the dollar tomorrow. There is also inflation that is always there. That too has an effect on the worth of that dollar. So we are going to be addressing that time value of money with the discounting models. So on pages 670 and 671, we're going to use those tables to discount that money that we're going to get in the future. So let's take a look at page 670, just so we get this concept of time value of money. It's the present value tables. So if you look across, there's a row, 1, 2, 3, 4, 5. That's for the years. So that's a year number. And across the top, you have a percent, 10%, 5%, whatever. So if you notice here, even at the 1%, $1 a year from now is only worth 99 cents. And if we keep going down the column, if it were 2% inflation, $1 today is worth 98 cents a year from now. And then it's 97, 96. If I'm in that 10% range, it's only worth 90 cents, right? That dollar a year from now is only worth 90 cents. If I go even further down the years, let's say 2 years, at 10%, it's only worth 82 cents to me today. So that's what discounting means. I'm discounting that dollar to today's value, right? Today's value if I were to get it 2 years from now. Does that make sense?
Mm-hmm.
Present value tables? Okay. So our discussion tonight will begin with the non-discounting. And that is, we're going to be using first payback period as one type of model that we can use to pick a project. So this is our first model. And the payback is discussed on pages 648 and 649. It's a non-discounting model, so we're not going to be using the present value tables at all. It is a great non-accountant tool. I think I've mentioned already, the person I worked for was not an accountant, so we use payback on a lot of our investment decisions. And his goal was he wanted his investment paid back within 3 years. So if the project didn't have that a goal or meet that goal, we didn't do it. So it's a very simple, simplistic model. How do we compute it? Well, it depends on if the cash flow is even or uneven. In this particular example, the cash flow is even. In this case, it's a simple division. So I'm going to take my dollar investment, $1 million, $2 million in this equipment, and I'm going to divide by the expected cash flow generated from this piece of equipment. The answer is how many years will it take to pay that investment back? So 2 years, 3 years, 4 years, whatever this division is going to give us. So example 1, which begins on page 648, has us do an even cash flow. And the even cash flow is letter A. So here's my even cash flow. This is problem exercise 1, letter A, even cash flow. Here's my investment. It's 100,000. I simply do a division of those two numbers. So how long does it take to pay back that investment? 2 years, right? That's the answer. Payback is 2 years. Now, that's an even cash flow. The other example, letter B in exercise 1, is uneven. So in this case, if it's uneven or unequal, we have to do a timing of that flow then by year. So the problem, if you go to the exercise for problem B, they have a really nice table. I like this table. It's laid out really well, and I think it shows very well how to compute an uneven cash flow payback method. So we had the $100,000 investment, right? In year 1, we are expecting $30,000 of cash flow. Obviously, that doesn't pay it back, right? I still have 1 year is used. So I have to subtract the 30 off the 100. What do I have left? I have 70 left. Year 2, 40. Again, I haven't recovered the 70, so another year passes, and then we subtract the 40 off the 70. What do we have left? 30. Well, this 3rd year, I'm expecting 50 in cash flow. Well, that's more than the 30. And then we do a percentage. What we had left was 30. What I'm expecting in year 3 is 50, generates 0.6. So my answer is in 2.6 years, I'll recover my 100,000. And that's what payback is that recovery period. There's no discounting. That's simply the return on my investment. That's all it shows me. How does that look? Okay? So, let's try one. Problem 31 in our packet. Page 682, if you're following along. Kayla, do you need the packet emailed to you? All right. It's coming to you. All right. There it goes. You should get it shortly, Kayla. On problem 31, let's start with Colby. Is this an even cash flow or an uneven?
Even.
Even, right? So when we're doing payback, that's the first thing we need to look for, is whether it's even or uneven cash flows. In this case, it's even. So then the payback is really simple. I take my investment and divide by the cash flow. And the investment in this case was $400,000. And the cash flow is $120,000.
$3.33.
3.33. And that's actually years. So in 3 1/3 years, basically, I should recover my investment, assuming, again, we estimate, right, that we have our 120,000 coming in every year. Now, be aware with rounding, CNOW is going to have some rounding issues again. If CNOW had asked me, enter this as 1 decimal place, what would your answer be? 3.3, right? Or 2 decimal places. Okay, so be careful with that. Let's look at Kyle here. The investment is 1.4 million, and then over the 5 years, she's expecting 490, 700, 420, blah, blah, blah. So do we have even cash flow or uneven? Uneven. So now I'm going to develop my table. So starting on the left, what was the investment?
1,400,000.
Yeah, 1,400,000. I'm going to go with cash flow in the column next, and then find the year in the 3rd column, or years. Those are payback years. In the first year, the cash flow was 350. Obviously, that's not enough to cover the 1.4 million. So I burn up 1 year in our payback period. What's left?
1,050,000, yeah.
In year 2, my cash flow was
490,
490.
yeah.
Obviously, again, that's certainly not going to cover the 1,050,000. So I'm going to burn up another year. What do I have left?
560,000.
560. Okay. And how much am I expecting in year 3?
8 months.
700, right? 700,000, which is more than what I need, right? Certainly more than the 560. So now I'm going to do a partial year. The investment amount over what I'm expecting, the 700,000, which generates a 0.8 number, right? I simply divide 560 by the 700 cash flow. So in this case, 2.8 years is what remains. 2.8 years. So it's not a difficult problem. We don't have to worry about present value tables. It's a non-discounting model. Pretty straightforward. Sean, Kayla, you're okay out there? Okay, excellent. Good job, guys. Problems 3 and 4 are just extensions of the payback using algebra. It's always good practice to use a little bit of algebra here again. For letter C or number 3, how much did Carson invest in the project? So now I'm on page 683. It says here the payback was 4 years. The cash flow is 960. So we can simply do a formula. We don't know X, which is the investment. We do know the amount of cash flow per year was 960. So how do I solve for X? We got to get X by itself.
Multiply by 960.
Yeah, both sides of the equation we multiply by 960. That gets X by itself. And I've multiplied this side by 960. And Tiffany, what is that number? 3 something, 3 million.
3,840,000.
840,000? So that's our answer for C. Just using the payback formula model and finding the unknown, in this case, the investment amount, 3.84 million. It's always good as accountants to know how to solve for the unknown, right? And then 4, very similar, just the only difference is cash received per year. Here we have a 2.5 payback with a 1.3 investment. And we don't know the cash flow is missing. So how do I get X by itself here? Yeah, we basically divide by the 2.5, right, to get X by itself. So here's what I would do. I would multiply both sides by X. Then it's really easy. And then divide by 2.5 both sides of the equation. And X is equal to, oh, I don't even know.
520,000.
520?
Yeah.
So this is the annual cash flow that we would need to receive every year to pay back this investment in 2.5 years. So that kind of rounds out the exercise for payback. Now, the use of payback is quite common, like I said, especially for non-accountants. There are some problems with it. For one, it doesn't look beyond the payback period. Oh, before we get to that, payback is a rough measurement of risk. The longer the payback, the riskier the project. So if I were to go back to our example here, I know they're different companies. 3.3, as far as a risk assessment, this is riskier than 2.8 years. And again, the theory is the longer I have to wait to get a return on my investment, the more risk that is involved in that waiting period. So it's a good measurement for risk assessment. Quick and easy. So that's what it's talking about. This is on page 649. And that risk assessment is also shown here, especially with companies that have liquidity problems. You would like to have, again, that payback period as small as you can. Another reason that risk comes in is obsolescence. If we buy a machine that will generate parts, and there's a new machine out there that generates parts faster, quicker, that, again, plays into that risk component. So it talks about computers and MP3 manufacturers have a much smaller payback period than most companies because of that obsolescence issue. There are some deficiency with the payback method. This is on page 649, 650. Please know this for the exam also. One is it doesn't look at the money beyond the payback. So remember, cash flows might have a slow time developing, and a lot of investments take that time to get a larger dollar amount. So that's a problem. It ignores that future cash flow. And number 2 here, it's a non-discounting model. And again, those cash flows are not discounted under the payback method. So that's the second problem with this model. So just review those couple pages for those multiple choice questions. Our next model is called accounting rate of return. Joe, have you seen this at all in your banking life? Accounting rate of return. It's on page 650. I'm just curious.
It's not standing out to me, but
Yeah.
I'd call it something different.
Yeah, it's very similar to return on investment.
Mm.
There isn't much difference. You've got a profit component on top, you've got the investment dollars on the bottom, and you come up with a percentage. And that's basically what accounting rate of return is. It is a simple formula. Here it is. Average income over the investment. Now, we talk about average income because it takes multiple years to basically figure out whether the return on investment was worth it. So we got to average that income across multiple years. So problem 2, or example 2, is an example of the accounting rate of return. And on page 651, it shows the computation. And it's much more complex than it needs to be. Let's take a look at the example, page 651. The first job, or the first step here, is to compute the yearly depreciation. And it's the straight line method. Does anybody know what the zero is here? I'm taking the 100,000 investment, I'm subtracting something and dividing by 5.
There's no salvage.
Salvage value, very good. So some of your problems will have a salvage value, some will not. Your 25-point problem does have a salvage value, so you will have to consider it there. But it comes up with an annual depreciation of 20,000. So what the problem has us do is take our cash flow, sales minus expenses, that's our net cash flow, subtract off the depreciation to equal our accounting income. This is very complex. Look at the depreciation number. It's all the same, 20, 20, 20, 20. So why are we doing it 5 times? Why don't we just average the cash flow numbers first, divide by 5, subtract the 20 once, and you got the same answer. So that's what I'm proposing that we do on our problem, our example here, is average this out first, then subtract the 20 once to get our average income. Don't do it year by year. So let's try this. The one I want to try is 32. We'll do A and B here. Do A and B here. First off with A, I like this one because it shows the cash revenues at 6 million. I'm on page 683 now. Problem 32. The cash revenues are 6 million a year. The cash expenses are 4.8 million. We have an investment of 3.6 million. going to subtract 0 because there's no salvage value. The life of it is 5 years. So if I take 3.6, divide it by 5, 720,000. And that is the annual depreciation, 720,000. Depreciation expense. Is depreciation expense a cash expense? No, it's a non-cash expense. But remember, we have to use it for the accounting rate of return, right? To come up with that income number. So, in step 2 now, what is my net cash flow? Now, when I use the word net, that means my outflows is netted against my inflows. So I'm going to take the 6 million. I'm going to subtract the 4.8 million. What do I have left? 1.2, right? The 1.2 is my net cash flow. But for accounting rate of return, I don't want to use my net cash flow. I want to use my net income. So what do I have to do now? Is basically subtract the depreciation expense. 720. And that should leave me with 480,000. The 480,000 is equal to my net income. Now if you look at the table, in year 2, don't I get the same number? Year 3, year 4, year 5, they're all the same. So guess what? I don't have to average because it's going to be 480. You know what I mean? Does that make sense? So this is not only the net income for year 1, it's the net income for every year. Well, guess what? That is my average then. Because they're no different. Every year is the same, 480. And then take what? Divide by my investment of 3.6 million. And I get what? For my accounting rate of return. What'd you get?
13.3.
13.3%. Is my accounting rate of return. A good number, a good solid profit number, right, for this investment. So again, let's just assume I've got 3.6 million. I could put it here in this company and make 13%, or I could put it in the market, maybe make 7. What are you going to do with your investment? You're going to put it here, right? You make more on your money here than somewhere else. And that's the goal with this model, is to figure out where do we, or what do we put our investment in. Let's look at A and B, project A, project B in letter B. So here, the investment is 75,000. So I'm going to start with step 1 again. Take my 75,000 investment. There is no salvage value again. And we're going to divide by the length of this, which again is 5 years. So there's 5 periods here that we're looking at. So 75, well, that's divided by 5 is 15,000. And that 15,000 is my depreciation expense per year. My depreciation expense per year. So we do need this number for our accounting rate of return. Step 2 then is I want to average the cash flows. Average the cash flows. I'm not going to do it by year like the book does it. That seems redundant. So for project A, I'm going to take the 22.5 plus the 30 plus the 45 plus the 75 plus the 75. Divide by 5 years. And what's my average cash flow? 49.5? Now that's cash flow, right? So this is the accounting rate of return. What do I have to do now? I have to make it a cash number to a profit number, right? So I'm going to have to subtract what?
Depreciation.
The depreciation. And that gives me 34,500 net income. And this is the average net income, right? The average net income. Once I have the average net income, now I divide by my $75,000 investment, and this yields what?
46%.
Which is my accounting rate of return. So for project A, my accounting rate of return is 46%. Really good compared to what we did before, which was 13% profit. What do you think? So step 1, I found out the expense per year. Step 2, I got the average cash flow, and then converted that average cash flow to an average income. That's what this is, average accounting income, 34. And then that's what we divide by our 75 to get the 46%. So for every dollar invested, this company's making 46 cents every year. That's what this is talking about. The profit is 46 cents every year. All right, this is a mutually exclusive analysis. So this company will either pick project A or project B. Looking at the cash flow numbers, which project's going to win? Project A. Hands down. Without even doing this, I already know it's project A is the winner. So let's go do it. Here again, we don't have to do the depreciation. We can just do the average cash flow first, step 2. $22.5 plus 30, 45. plus 22.5 plus 22.5. And we divide by 5. Kayla, by chance, do you have that number? Would it help if I showed you that 142.5? And I divide by 5, which gives me what? 28.5.
Yeah.
I subtract off the 15, the expense, the depreciation, and I get 13,005, which I then divide by 75 to give me an accounting rate of return
18%.
18%. Did it come out to 18 exactly?
Yeah.
So obviously, which project are we going to do?
A.
A, right? So obviously this is the best of the two, right? 46 is much better than 18. So that's pretty much slam dunk here for this analysis. Again, there's some algebra questions in C and D. I'm just going to skip those. The fact of doing the accounting rate of return, that's what you're going to do on the test. Any thoughts on this? Any questions? Guys, Kayla, Sean, you all right? Thank you. Excellent, Sean. Let's take our first break then, guys, and we'll come back and do the discounting models. There are limitations with the accounting rate of return, and they're shown on page 651. Similar to the payback period. Like payback, the drawback with accounting rate of return, it does not ignores the time value of money, so we didn't do any present value computations here. Also, a limitation with the accounting rate of return is that this net income can be manipulated by managers. We can remember we talked about that already, where managers can change the flow of expenses, reduce repairs, that sort of thing, to influence their net income. So it's got that short-term perspective again, taking only those investments with the highest rate of return in the present, right? As again, and that's the goal here with managers, they get paid based on that amount of income they make. So obviously they're going to pick the shortest term with the highest profit margin. So just be aware of that, because again, our incentive here is to pick that capital investment, which is a long-term investment, that over the long term will give us the most profit, not maybe so much in the early stages of that project. So just be aware of those limitations. So our next model is now in the use of cash flows and discounted cash flows. So now at this point, starting on page 652, we will be using the present value tables on pages 670 oops, and 671. We'll talk about the two different types. One's the present value of $1, and the other is the present value of an annuity. There's two different types of cash flows. So, what does net present value mean? It's simply the difference. It's the difference between, so we're going to do some subtraction here, between the present value of the cash flow in versus what we paid out. So it's a dollar amount. It's either going to be a positive dollar amount or a negative dollar amount. And the book talks about that dollar amount, and it shows the formula here. If it's greater than 0, if the net present value is greater than 0, we would accept the project. And obviously, if it's less than 0, we would reject the project. But I do want to point this out. This is on page 653. To get a positive net present value, we have to basically get, one, the return on the investment, two, earn a profit on that investment called the required rate of return. So the company will be giving us, or all the problems will be giving us, what the company desires as their profit margin on an investment. And then third, we'll have some excess profit beyond the company required profit. And that's what makes it positive. So all three of these are needed in order to get this positive net present value. I want you to know what's contained in that net present value. It's the initial investments being paid back. They're making the desired company profit plus a little bit extra. And it just shows here, if the net present value is 0, we can either accept it or reject it. And then obviously, if it's not or below 0, we would reject that project. So please know that. If it's below 0, we're going to reject that project. It's earning less than the company's desired rate of return. Example 3 is our example for this. This is on page 653 also. These are problems that are not difficult. It just has a lot of information to get to where we need to go to. So here we're looking at a new project, new earphones. They revealed the expected annual revenues of $300. The equipment will cost $320. It can be resold for $40. In addition, there's working capital. We'll talk about what that is $40,000 in inventories and receivables. I guess that's what they're telling us. And then the firm expects to recover the investment in working capital at the end of its project life. Annual cash expenses are $180. And the company's desired rate of return is 12. So a lot of information here, guys, and it's spread out. You know, first we started with revenues, then we went to the investment, and then we went to working capital, and then at the end it talks about expenses. So it's not laid out very pretty. So what I do like about this problem is the table. So it's a cash flow table. This is what I would like you to use in working with this type of problem. So let's take a look at what's happening here. I know it's a little blurry, I tried to blow it up. In year 0, this should be on page 653. In year 0, what happened? Well, I spent some cash on the equipment, and I spent some cash on inventories, supplies. They even said accounts receivable because I'm not getting my money right away. That's called working capital. This extra money that I spend, because remember, you just don't plop a machine on the floor and then plug it in, right? Sean's finding that out. You gotta do more than just plug your wash machine in and go, right? There's a lot of effort that's needed to get that machine running. So that's what working capital's about. So I'm spending in total $360,000. That's in the paragraph. Now, in years 1 through 5, right?
1, 2, 4.
Well, I know it says 1 through 4, but also 5, I'm getting $300,000 of cash in, right?
Yeah.
Per year for 5 years. Also, I'm paying out 180 every year for 5 years. So remember, the part that I'm making, right? I'm selling for $300,000, but I've got materials, labor, and overhead that total 180. That's going out. So in net, I'm getting 120 net cash flow. Does that make sense? But what's different in year 5 is what's happening. This, I sell it for $40,000 at the end of its life. That's my salvage. And I'm also selling all those inventories and supplies that I no longer need at the end of its useful life. So instead of the 120, right, net cash flow, in year 5, my net cash flow jumps up to 200. So now I have an uneven cash flow at this point. Does this make sense? Taking that paragraph and coming up with a schedule of cash flows. Because this is what you're going to have to do. And we'll practice this. After we know the cash flow per year, what do we do next? We have to discount them, right? We have to discount them. You'll notice here, there's a middle column, discount factor. From the tables on page 670, let's go to the 12% column. Let's jump to page 670, the 12% column. Look at column where it says 12%. Year 0 is obviously 1, right? That's the present year. Go to row number 1, which is year 1. Do you see the 0.89286? And then year 2 is 0.79719. Year 3, year 4, year 5. These are the numbers you should be seeing in that 12% column. Now, what is the 12%? The 12% is the company's desired rate of return, desired profit on the project. They want to make 12% on their investment. So if I'm investing $360,000, I want to make 12% every year for 5 years. If I don't get that, I don't do the project. So now I take my individual cash flows, right?
Yeah.
And I'm going to multiply them by the discount factors to get my present value of that money in today's dollars. So now I'm comparing my present value of my future cash flows to my present value of my outflows. And I come up with a positive net present value. So should I do the project?
Yeah.
Heck yeah. I'm recovering my investment in 5 years. I'm recovering the 360. I'm also making 12%. Plus I'm making more than 12 because I have a positive number here. So yes, it's a very good project for me. Does everybody understand why I use table 1?
That's because go by year.
You can go by year
Uh-huh.
because it's not the same, right? In year 5, it's a little different. However, there are 4 years that are the same, right?
Yeah.
And that's what a second method can be used. A second method can be used for those years that are the same. Which years were the same?
2, 4.
1 through 4.
This-
Now, I want you to go to page 671 for that factor. Page 671, row 4, 12% column again. So I'm on the 12% column. That's what the company would like to make on their investment. Can everybody find the 3.03? 12%, row 4.
Yes.
You see it, Julie?
Mm-hmm.
You got it?
Yeah.
Why am I picking row 4?
It's like they told 1 to 4 years.
It's 4 years for 4 years it's the same amount, right? That's why I'm picking 4. And multiply it by the 120. I get 364 for those 4 years present value. And look at what I did. On year 5, I had to go back to page 670, right? It's a one-time deal. Present value of one number discounted back to present value today's dollars. You'll notice that this is the same number as up here as I used down here. This is the most complicated part of the chapters right here. Any questions that you can think of now before we try one? Oh, I want to do one more thing before we try one. Let's pull out your calculator. Let's try it. It's probably been a while since you've done cash flows on a calculator.
Yes. Yeah. According to the that is according to the
Does everybody have a financial one? Pull her out. Sean, Kayla, do you have a financial calculator? Okay, thanks, Kayla. Sean, I'm assuming you're putting your wash machine in. He must be. All right. All we're going to touch, the only keys we're going to touch on our calculator are the keys on the second row, where it says second cash flow, net present value, internal rate of return. So we're looking at the second row here. Can I have you click or select CF for the cash flow? Whenever you do a cash flow problem on your calculator, clear it out, okay? Even if it does have zeros, just to be sure, hit second function, clear work. So I'm hitting the second function, clear work on the bottom left corner, just to make sure there's 0. So, what did I spend in year 0 is what it's asking now. Cash flow in year 0 on our problem. How much money did I spend? 360, right? So type in 360. Oops. And make it a negative. Add the negative symbol in front of it, because that's the cash outflow. Then hit the enter key. It's right above the CF. It's the enter to set it.
Is that cost, not cash flow, right?
Well, it's cash out.
Oh.
360 being spent. Then upper right corner is a down arrow. This is freaky. That didn't happen to me before. Let me try it again.
Can you start? What did I say with?
Something happened, and I don't know what.
Go down. Little bit down.
Yeah, I think it says,
I don't know.
oh, so does mine. Yeah, so does mine.
There it is. Do you have CO1?
Yeah.
Okay. I don't know why it
Is
was.
that right?
Yes.
Oh, okay.
Put in 120,000 and hit enter. Down arrow again. It should say F01.
Yeah.
Mhm.
How many years did we get the 120?
Four.
4.
Four, yes.
So put 4 here for the number of years. I'm not sure why they use F, not Y, but.
Yeah.
And enter that. Down arrow again. Cash flow 2 would be what amount?
No. Can go to the 200?
Yeah, the 200,000 that we got in year 5 would be cash flow 2, 200,000. Enter that. If I down arrow again, for how many years did we get that 200,000?
5.
In year 5, but how many times?
One.
1. So it defaults to 1 automatically, so we're going to leave it there. Now switch to the center button that has NPV on it, and you should get the letter I. What was the desired rate of return for the company on this problem? 12%, so enter 12. Once you enter, hit the down arrow again, and it should come up with NPV.
Mhm.
Now, do you see? Oh, just go to NPV. Just hit, yeah, there's nothing in periods.
Yeah.
Oh,
And then put 12,
Enter.
12, and then enter.
Okay.
Down arrow. And you should have NPV.
Yes.
Zero.
Then hit compute, CPT. You should get 117,967. And if you look at our answer, it's at 117,968. So it's within $1. Now, for C now, guys, you're going to have to use the tables.
Mm.
You can't use your calculator because there will be rounding differences.
Oh.
But at least you can verify it. You know what I mean? On the test, though, you can use your calculator exclusively. Just know that C now may mark them wrong. I will come back and mark them right if they are within what they're supposed to be. So for the test, you can exclusively use your calculator for all your net present value. If you go to the next button which says IRR, click on that, please.
Mm-hmm. Internal
Internal rate of return is the other discounting model. Just hit compute. And you should get 23.59%. So basically the goal was 12. The project actually is generating 23% return. So again, a very good project for us. So this certainly would be one that we would accept then. Okay? Now we'll practice this once we get to our problems, which we'll do now. Any thoughts or questions at this point? All right, let's work on clearing out our cash flow. Go back to CF. Click on CF. Hit the second function, clear work. That should get our cash flow columns or rows cleared out. I'm just going to minimize this now. The first one I want to try is problem 33. We'll use our calculator, we'll use our tables, just to get a little more practice here, guys. Page 684 again. If you want to fold over your page at 670 so you can get back to it, or put a paper clip on it. Problem 33. Campbell's considering the purchase of a new welding system. The cash benefits will be $480 per year. The system costs $2.7 million and will last for 10 years. Now, it doesn't talk about the company's rate of return until you get into the required section for question 1. It says compute the net present value for Campbell using a discount rate of 12%. That's the required rate of return, 12% for the company. Even cash flows, so I've already got that identified. Year 0, what are we spending?
270, 2 million.
2,000,007, right? That's my negative. Even cash flows, years 1 through 10, how much am I getting?
480.
480 plus, right? But I'm going to multiply that by some number, right?
Yeah.
The key is, what is the number?
12% year 10.
12% year 10. Okay, so let's go to page, which page though? 670 or 671?
71,
71, why, Tiffany?
because it's more than 1 year.
It's more than 1 year. What do we call that item that we get every year for the rest of my life? Annuity. Very good, Joe. And if you look at table, the heading on it, it's the present value of an annuity. Annuity means I'm getting a certain dollar amount every year for, in this case, 10 years. So Tiffany, what column do I go to? I go to column 12%. What row?
10,
10. And what is the discount factor for that 10?
5.65022.
Perfect. Does everybody see that number? 5.65022. This is where, again, it may be beneficial to have a ruler to be sure you're on the correct row. You can be off one row and then that's going to change your answer. So once I multiply this 480 by 5.6500022, what amount do I get?
12,106. 12, 12, 1, 2, 12. 12,106.
Sorry, I can't.
12,000.
12,000.
12,000.
2,712,000.
Oh, that's better. I was gonna say, I don't have 12,000. 712,
And 105.
105. So that's a positive number, right? So that 480,000 for 10 years is valued at today's dollars 2.7.
It's actually 106 rounded.
So I have a positive cash flow, right, of 12,000. This is my net present value. It is a dollar amount. So we went from payback, which was years, accounting rate of return, which was a percentage. The net present value is a dollar amount. So would I accept this project?
Yes.
Yes, it's positive, right? So I'm recovering the 2.7 million. I'm making 12% on this project per year for 10 years. And I have a little bit more extra. So the answer, should I proceed? And yes, positive net present value. We would proceed. Let's try another one. Evie. The cost of the investment is $270,000. She thinks that she's going to get $52,500 per year for 6 years. This time, the discount factor in question 2 is 8%. 8%. So I'm going to lay it out the same way. I have my investment, $270,000 in year 0. We're expecting years 1 through 8, 52,500. But I'm going to multiply that by what amount? Julie, what do you think here? It's an 8% expected return for 8 years. Is it 8 years or is it how many years?
It's for like 6 years.
6 years. I'm sorry. 6 years.
Oh,
What's my number?
um, 4.76654.
4.76.
654.
654.
That's
No.
No?
You're 1 over.
Oh,
You're in the 7%
Yep.
column.
Yeah.
oh, okay.
So it's
4.62288.
yeah.
Yep.
Thank you.
4.62288.
4.62288.
Mm-hmm.
And how much is that?
Oh, 242,701.
So my net present value can be 0, right? Or below 0. It can be negative. Is it negative by 32?
27 to 99.
That sounds better. So should she proceed with the purchase of the new specialty shop? The answer would be no. Negative. Net present value. Shouldn't proceed. We're not making even the 8% number, right? Not making the 8%. Let's do the next two, or next one. This is still B, but let's use our calculator here. So what changed is the amount of cash flow expected. We're still doing a $270,000 investment. We're still doing an 8% expected return. The only change is that we're now using 135 as our cash flow per year. All right, so we're starting on cash flow. We're spending $270,000 at zero. 270 negative. Make sure you put the negative in. Enter that. Once you enter it, down arrow. The cash flow is $135,000 per year for 6 years. So I'm going to enter the 135. Down arrow. How many years?
6.
6 for F. And enter that. Always remember to enter. That's the big thing when you're doing these calculator problems. So are we good with cash flow? That's all we need to do. We put in our investment, 270 negative. We entered in our cash flow, 135 for 6 years. We go over to the net present value. What is I?
8%.
8%. So we enter 8. Down arrow.
Did you enter it?
After the 8 is entered, down arrow. And then hit compute.
Enter down arrow. Okay.
I got 354,000. Is that what you guys got?
Yeah.
You
What
need $8.75.
Yep.
is
So you should get a net positive number of 354,088.75 using our calculator to get that answer. So obviously now it would be beneficial. Guys, did we get that?
No.
Okay, did you get the cash flow in, Julie?
I'm gonna clear it.
Let's clear it again.
Enter.
You should have 270 on the CFO.
I got CO10, so that's how far I am. And then after that, I put in the 135,000.
Yeah.
And hit cash flow.
135. Enter.
Oh. Sorry, now I gotta start over.
Yeah, just hit, go to cash flow, click cash flow first.
Yeah.
There you go. Now enter the 270 negative. Enter. Down arrow. 135.
Enter.
Very good.
Okay. And then
6.
6.
Enter.
Enter.
And that's it.
But then I have to put 8 in.
Now you have to put the, click on the net present value.
Okay, that's right. Okay. And then 8.
Now 8.
And then enter.
Yep.
And,
Down
Okay.
arrow again.
oh, down. Okay.
Now you see you have NPV shown. Now you hit compute.
Okay. Thank you.
I'm just curious, did anybody try the internal rate of return? So I'm just going to click IRR, compute. It's 44.51%, which is much greater than the 8% that we desired to make, right? So huge, huge difference. Very profitable based on that type of cash flow. So obviously, should the owner invest? Of course, with that kind of cash flow, certainly would. All right. Kayla, how you doing? Okay, good. Let's clear out our calculator again if you get a chance. So click on cash flow, second function, clear work. Just so we're ready for the next problem. Couple of things to realize as we're doing these cash flows. As the discount rate increases, the present value decreases. So I'm looking at this. As the discount rate increases, the present value of the future cash flow decreases. So it's harder for a project to achieve a positive net present value as the rates go up. So be aware of that. And a lot of companies will do that analysis in order to incorporate risk. If they feel a project is very risky, they'll increase that percentage to see whether it still generates a net positive or net present value if that is positive. So keep that in mind. Our final computation tonight is called the internal rate of return. And this is very easily done on our calculator. It's just one button. So that's what makes it really nice. 656. Is defined as the interest rate that sets the present value of the cash flow equal to its cost. Or in other words, the internal rate of return is the point at where net present value is 0. You must know this for the test. This is a multiple choice question, guaranteed. The internal rate of return is the rate of interest that will generate a 0 net present value. A 0 net present value. In other words, the cash flows equal the cost of the project, right? Those present value cash flows equal the project's cost, gives us a net present value of 0. So the IRR has to be greater than the company's required rate of return. In order to be acceptable or an acceptable project. If the internal rate of return is below the company's required rate of return, obviously we would reject it. So it's a quick, easy computation to determine whether we should do a project or not do a project. So here's just a formula. Don't worry about that. Talks about when we would accept and reject the project. For the test, on page 656 again, of the two discounting models, because of its simplicity, because it's one number, it's the most commonly used capital investment technique. So please know that. It's really easy to compute if the cash flows are uniform. It's not easy to compute if the cash flows are, excuse me, if the cash flows are uniform, it's easy to compute. It's when they're not that it's not easy to compute. So example 4 on page 657 does a internal rate of return computation. Here we have an even cash flow of $50,000 with an investment of $205. It generates a discount factor of 4.11. So to get the internal rate of return, we have to go to the annuity table. So on page 671, the annuity table, what percentage is the 4.114? On row 6, you have to use row 6 because it's a 6-year project. What percentage are we at?
671.
Page 671, the annuity table, row 6.
4%, 12, can I do 12%?
Does everybody see 12%? So this equates to an internal rate of return of 12%. That's how you use the tables to find that number. But that only works if the cash flow is even. If the cash flow is not even, use your calculator. Okay?
This for even, right?
This is only used for even cash flows. So this 50,000 is the amount for every year for 6 years. This is an even cash flow. That's the only way this one will work. If it's uneven, use the calculator. All right, so I'm going to skip a bunch of stuff here. Let's try a problem here. 34. All right, we're looking for internal rate of return here. This again is even cash flow. How do I know it's even?
When you see the amount of cash and expense and revenue are the same each year,
So what is the net cash flow for Seneca?
equipment would go and have the rise, so that's the net one, right? So we have to subtract depreciation.
No, no, there's no depreciation here.
Oh, and,
Net cash flow is what?
oh, okay, 2
2 million.
Mhm.
Yeah, yeah. So my discount factor is equal to my investment. The 2 million is the sale number, the revenue minus my expenses. That's the net cash flow. So 7.2 divided by 2 million gives me a discount factor of how much? Three something, right?
3.6,
3.6?
yeah.
Okay. So let's go to page 671.
For 5 years.
What row do I go to?
5 years.
5?
Yeah.
Yep. Row 5. Kayla, what's my percentage? 12 again? Okay. The 12% is my internal rate of return.
So, even if that's just 3.6 and it's not exactly what it's in there.
Yep.
You just go with what
The
it's-
closest one.
Oh, okay,
They call that interpolating.
okay.
So it's whatever is closest between 12 and the next one is 14.
Mm.
Yeah, you pick the closest one. Yeah, see now's answers will always be 12, 14, a whole percentage. It's not going to be. Now your calculator will be 12.6667. Well, you just enter the 12. Whatever is closest in whole numbers. Now, should the company proceed with the purchase, though, is the question. What's the company in requirement 1? What did the company desire to, and the required, what did the company want to earn?
16%.
Yeah, very good, Julie. So I'm in requirement 1. The company desired rate of return was 16%. My IRR of 12 is less than the company's 16 desired, or they call it what, cost of capital? And sometimes this is called the hurdle rate, right? So just be aware of that. So knowing this, 12 versus 16, would we accept? It's less, right? No. I'm not even making 16%. So, no, don't accept project. If I know this, what can I say about my net present value? Is it positive or negative?
Probably negative.
Yep. If I know my accounting or my internal rate of return is less than the company's desired, I already know then that my net present value is going to be negative. Both models will give the same result of acceptance or rejection. You will need to know that for the test. If my internal rate of return is less than the company's desired rate of return, I know my net present value is negative. And vice versa, if my internal rate of return is greater than the company, I'm going to know my net present value is going to be positive. So again, very simple analysis. The rest of these are pretty similar to what we just did. I want to touch on some other ones. I'll copy the answer keys to these from my other classes, just so you have the answer keys if you want to go back and look at them. Let's go to problem 40 and then we'll take our next break. Page 687. We have two projects. Project 1, Project 2. We have to pick one. We're going to compute the net present value first, and then second, the internal rate of return. I want to use the tables, though. I don't want to use our calculator. So let's use the tables. Year 0, how much did I spend in project 1?
Negative 100,000.
Yep, 100,000. Year 1, did anything happen? No. Year 2, how much did I get?
134.
134,560, right? But I have to discount this to today's dollars. So what number do I multiply by? Or which table do I use?
Just plus 1 because it's
Which table? 670 or 671?
670.
670, right? So page 670, the present value of $1. Okay. Obviously we're in row 2, but what column? What is the desired rate of return for this particular company? 10%. Does everybody see that?
Yeah.
It's called the cost of capital. Means the same thing. So what number do I multiply this by? 82.
645.
615.
45, sorry. 45.
45. Did they have a positive net present value? Joe? No? No? Britt? Tiffany? Is it close?
Yeah.
How much is it? Go ahead, Tiffany.
111 111 triple 1207 207. Yeah,
So we made it, right?
yeah.
Positive net present value of 11,207. Let's do project 2s. looks like a much better project. Same amount of money is spent, right? Year 0, 100 grand. Year 1, I'm getting 63,857. Year 2, 63,857. What does that look like? I can use
The
either.
same, yeah.
Yeah, they're the same. So what would be a good way to get the present value?
Yeah, go to table.
Page
Year 2.
671, table 2, the annuity,
Yeah.
row 2, right?
Mhm.
10% again. So what am I multiplying this by?
22,645. Oh,
Oh,
no,
no.
page.
Had to be 671. Think that's all.
Joe, go ahead.
Or 1.73554?
Yeah.
1.7.
3554.
Obviously, we're only going to multiply it once, right? Don't grab both numbers and multiply. Because it's the same number for 2 years.
110,826.
110. 826.
Yeah.
So 10,826. Well, again, positive, right?
Yeah.
So we could do either project, right? So let's do the IR quick. Project 1, let's use our calculator. Because it's an uneven cash flow. So what am I spending? 100,000. Negative. Enter. Down arrow. What's my cash flow in year 1?
0.
0. So I don't have to do anything. Hit down arrow again. How many years? 1. Enter. I better go back and make sure that's 0. Yeah, it should be right for 1 year. What did I get in year 2? 134,560. Enter that in year 2 for how many years? Just a 1. That's it. That's all we got to enter. So the initial investment, 100,000. Cash flow in year 2, 134,560. Julie, did you catch all that?
Yeah. Looks like we did nothing. I
So
guess I'll
go back to cash flow.
Yeah.
Good. So put in a 0 here and enter that.
Oh, okay. Tuck it down.
Mm-hmm.
Okay.
For 1 year, it's already there.
So I do have to put that there. Okay, we'll leave that there.
So down arrow again.
Okay, and then,
Cash flow 2 is the 134,560. Enter that. Down arrow. It's already defaults to your 1 year.
okay.
That's good. So now go over to IRR, because that's what we're computing, and hit compute. So go to IRR, and then hit CPT. I get 16%,
Oh, yeah.
right? 16% is my internal rate of return. What was the company's desired rate of return? It was what?
10.
10. So that shows again that positive net present value. Gives us an internal rate of return that's going to be greater than the company's desired rate of return. So this is the company's desired rate. Got 10%. Let's clear out our cash flows quickly and do project 2. So I'm going to clear it out with my second function clear. We had the $100,000 investment. In year 0, put a negative, enter. We hit the down arrow. Cash flow year 1, $63,857. Enter that. For how many years though?
2.
So F needs to be 2. And enter. Go to internal rate of return then and hit compute.
Do I have to hit down after enter?
We got an error.
You got an error?
Yeah.
I got 1798.
I'm on the year. Do I hit down?
You shouldn't have to because it defaults to 1. Oh, yeah, hit enter if it's 2.
And then done?
No, you're done.
And then just,
Go to IRR, compute. 17.98, which is 18%.
I got that.
You got it?
Yeah.
Good job, Joe. Okay. So, according to IRR, which project should I be doing? Project 2, right? But net present value said which project should I be doing? Project 1. So now we have a dilemma. And the winner is net present value. Could I have you turn your page if you have mutually exclusive projects, and that's what we have here,
Project 1 got the 16% even.
sorry guys, I gotta jump here ahead.
yeah, for sure did.
Here.
Okay, I subtract into and then go down here 1 is 0, right?
Yeah.
And then you do anything.
No, and then you just
Go down and 0 here.
You have to make them that 2 now. 'cause
No,
that's- that's
I
zero, isn't it?
add the project 1 and then get 16.
I need you to know this for the test. Page 662. If we have mutually exclusive projects, the net present value should be used to pick the best project, not internal rate of return. Just like our example on example 40, the net present value for project 1 was greater than project 2. And then for the internal rate of return, project 2 was better than project 1. But net present value is the winner here. So there is a multiple choice question on this. When you have 2 projects, 2 competing projects, you will use the net present value to determine which project to pick, not the internal rate of return.
Which time is the number?
Oh gosh.
Oh, you don't, okay.
I jumped way ahead, Julie.
Oh, I see.
It's on page 662 in your book,
Okay.
if you can highlight that. Toward the bottom, probably there.
I read it just today.
And if we go to our problem, the problem we just did, problem 40, you can see that difference, guys. For project 1, the net present value is 11,000. For project 2, it's only 10. So on competing mutually exclusive projects,
It's tile 58.
tile 58.
Anybody wants to know?
Okay. So when you have competing projects, use net present value. It gives the company the greatest amount of wealth. And that's why we use net present value. Okay, let's stop here. We'll take our next break. And we'll do a couple more practice problems. And I want to talk about the project also. So problem 45 needs some help. Problem 45 on page 689. Please go to that page. Again, it's not a hard problem. It's just that the information is just spread everywhere. So go ahead, take a look at the problem, read that paragraph, and then we'll talk about it. I do get a lot of questions on problem 45. So I did a slide, a separate slide for this, outlining what needs to happen. First off, each year the company spends $3,000 in cash expenses. So remember with cash flow, the net cash flow is revenue minus expenses, correct? So that $19,800 is the money coming in year 1. I'm spending $3,000 in year 1. And I'm spending $3,000 in year 2, and I'm spending $3,000 in year 3 and 4. That make sense? Next item is the salvage value. It's $6,000, right? We do need it to compute the amount of depreciation expense, and that's it for the accounting rate of return. So right now, I'm here. Only use the salvage value to compute the expense amount. The salvage value of $6,000 does not or is not included in the accounting rate of return period 4 revenue. Remember, accounting rate of return is the average profit, average income over the investment. Sometimes students want to add the salvage value as part of the average income, and you do not do that for the accounting rate of return. We don't include the salvage value. We only use it to compute the what? The depreciation expense per year. Is that clear? Okay. Now, it changes though when we get to the net present value and the internal rate of return computations. Now the salvage value will be received in year 4. Does that make sense? So what did we get in year 4? We got $32,400 of revenue. We spent $3,000 in expenses, but we gained $6,000 in salvage value upon the sale of the equipment. So this is considered cash in on that period 4, right? Cash in on period 4. Unlike our other problem, there is no working capital increase or decrease. Okay, now I'm not done here yet. Oh, Gary, I wish you were. So if I go to the problem, 45, I'll make it bigger. There really isn't a lot of boxes here to fill in. It's more information than anything. So, requirement 1, it says compute the payback for the new equipment, right? Payback. Problem 2, the accounting rate of return, we already talked about it. And look at the percentage. Round your answer to 2 decimal places as a percent. As a percent, not a decimal. Question 3, what is the net present value? What is the internal rate of return? Use your calculator to compute the internal rate of return, please. And they want a whole percent, 12, 14, 16, 18. Don't use your calculator's answer of 12 point blah, blah, blah.
You round
Round to the whole percent when you get to question 3, internal rate of return. C now is assuming you're using the textbook, and they don't have anything more than the whole number. Okay? Now, question 4 is, basically it says, hey, these revenue amounts are way too much. We're not going to hit them. So in problem 4, it says, the conversations reveal that a less glowing report was received. The new procedure reduced the time by 25% rather than the 50. The doctor then estimated that the net operating cash flow of the procedure would be cut by 1/3. So, guys, I'm right down here now. 1/3. Reduction in what? In the net cash flows. Do you see that on the problem? This is for question 4. I really would like you to get this question right. Sometimes students, it's the end of the semester, I give up, I don't care, it's one question. You see how that I can see how that happens. I'm the same way. I would do that same thing. I got an A or B or anyway, so. But I want to get you to have the right answer. What does net cash flow mean? After expenses, right?
It's called 1/3.
The 1/3 is not on the revenue. It's 1/3 on the net cash flow. Or can't I take 2/3? Right? Instead of getting all of the cash flow, 16.8 in year 1, I'm going to get 2/3 of it. That's what I want you to do for part 4. How does that look? Tiffany? I know you've been sitting there for such a long time. Joe, what do you think? For problem 4, you have to reduce the net cash flows by 1/3. So what do you have left? 2/3. In year 4, right? What is this, 29? Remember, we have the salvage value coming in year 4. We don't reduce the salvage. We only reduce the cash flow, not the salvage. The $6,000 is not reduced in year 4. Okay? So that's another thing that plays into this net present value computation. Because that's what you're trying to do in problem 4, is compute the net present value, assuming the cash flows are reduced by 1/3. That's the goal there. So I'm going to screen capture this. This 1/3 is only for question 4, right? Not the other 1, 2, 3. Just for question 4. How's it going to work? Is it going to work? All right, that's the goal. See how you do. Let me know if you have questions, right?
Gary, you gonna have those notes on Blackboard?
Yes, I am, Joe.
Okay.
It's already captured. Here it is.
Okay.
So it's right after my notes, my other notes, with question 4, that 1/3 reduction.
The operating cash would be cut by 1.
I do want to try one more problem
Okay.
tonight. Problem 35. It's in your packet. I like this one. We're only going to do one part of this. I might do part of question 41 too, but let's start with 35.
And completing project. When we say completing project, like we have to pick, right? We have to pick which one the best.
Kayla, Sean, I didn't ask you. Are you okay out there?
It's the same. This how they cost of capital is the same.
All right. Thanks, guys. You guys are awesome.
And laid up into.
All right. Problem 35. I've already got it laid out. Right? You got numbers? Cool.
Yeah, I just confused about. Sometimes they are the same meaning. Sometimes they use the rate of return, the discount rate, the capital rate. They are the same.
They're all the same.
Oh,
Mhm.
okay.
Yep. Yep. 12% is our discount rate.
Oh, yeah.
So that's where we're going to grab these numbers. Author likes this 12% for some reason. A lot of the problems use that column. So I've already got it laid out. The discount factors, obviously 1 in year 0. So I'm spending $560,000. That's what I'm spending. That's my investment. And then I'm going to go to page 670 because it's an uneven cash flow. I got to discount 5 different periods. So here are my numbers. 0.89, 286, 0.79, 719, 0.71, 78, 0.63, 552, and 0.56, 743. And then we're simply going to multiply those out and see if we come up with a positive net present value. I'm going to round to the whole dollar amount. So 285, 715. $223, $213, $170, $827, $101, $683, and $68,092. So we then net these positives with the negative. And I eventually end up with a positive net present value of 289,530. Pretty good cash flow. So these are from these discount factors, 670, present value of $1. Just gives you some practice. And here again, you could put these cash flows in your calculator and then compare it. See how it comes out compared to the book answer of 289,530. I hope I didn't do any math errors. If not, the calculator will help too. Is everybody comfortable with the discount factor, where to find it? Why it's there? All right. The other problem I wanted just to touch on briefly is problem 41. This is probably the most complicated one that you can get. Now here I did not put the amounts in. I did put the years in though. We have two outlays going out in year 0. The 1.2 million is what the equipment will cost. But there should be something regarding working capital. It's 120. So that's what I'm spending. Obviously the discount factor is 1. So my present value, because it's already in year 0, is the same number. So I'm actually spending 1.32 million on this project. Now I have years 1 through 7 combined. This is the net cash flow per year. What is the net cash flow number that I'm expected to get net for 7 years? What's the positive? What's the negative? positive what?
400,000.
400? Does everybody see that? It's called savings. Is that what it says, Aaron? Cost savings?
Yeah, I'll save cost.
The negative is how much?
270.
To get the savings, I'm going to spend 270. The net is what? The net cash flow is 130. Does everybody see where the 400 is coming from and the 270? And did you notice that they put the expenses first and the 400 last? So again, it's really making you work to understand the problem. I'm going to put 130 up here for 7 years. This is an annuity, right? So what table do we got to go to?
671.
671. Row 7, right? Row 7. What is the company's desired rate of return? 12 again, the cost of capital. Yeah. For whatever reason, again, the discount factors are on the 12%. Page 671, which is the present value of an annuity. And Joel, what is the factor then?
I believe it's 4.56376.
Okay. And then we multiply that out. I'm going to round it to the whole dollar, 289. So if that's my savings, my net savings, I'm in trouble because I'm not going to make it, probably. There's not enough money to do this. Look at year 5. What happened in year 5?
You get to pay more money.
Yeah, you have an overall. So another negative of 120 in period 5. It's a one-time occurrence. So which table do I got to use now? 670. Row 5, column 12%. Tiffany?
0.56743.
$68,092 negative. And finally, in year 7, I sell the equipment for how much?
96,000.
Yep. That's a positive. And then I sell the working capital for 120. Now I can combine those two together because we're going to multiply it by what amount?
0.45235. 235.
Because it only happened once, right? So we're back on the present value of $1 for those two amounts. And that's it, guys. So I multiply this out. $43,426.
The other one's 54,282.
Do you have the net already, Jill?
Yeah, it's negative 697,095.
So it's a huge negative net present value. No way in the world would you ever do this. Okay? Unless you get some government help to subsidize the effort, right? Certainly would not do this. I'm thinking ethanol. Just my point. All right. That's the toughest one you'll see. So again, lay out the cash flows, know what table to use, whether it's annuity or present value, and it should hopefully lay out pretty good for you. I do have one more comment. Can I have you go to page 680, please? There are other problems, guys. I'm going to just give you the answer key. Oh, wait a minute. There's one I want to show here. Yeah, go to page 680 first, and then I got one more problem I want to do yet. Exercise 22, please. They want the accounting rate of return. Kayla and Sean, can you get to page 680? Problem 22. Thanks, Sean. Kayla, are you... Okay, awesome, Kayla. Thank you. If you notice on this problem, problem 22, it says the net income stream is 360, 360, 600, and so forth. Do you see that? What I want, and we want the accounting rate of return, right? What I want to make note is that the depreciation expense is already in this net income stream. So they use a play on words. Sometimes I'll give you the net income stream, or versus I'll give you the cash flow stream. If I give you the cash flow stream, guess what you got to do? Now I have to subtract the depreciation expense from the cash flow to get what? My net income stream. So know the difference. I get emails a lot on problem 22 because students they think they're doing this like they did in the problem. They're taking the number minus the depreciation expense. You don't do that because 22 has already got the depreciation expense taken out. Is that okay with everyone? Does that make sense? So the net income stream is exactly what I need. I'm just going to add up those 7 numbers, divide by 7, I got my average income. Done. But if I give you instead a cash flow stream, then yes, you do have to subtract the expense to get the income. So watch for that. Kayla, Sean, you're cool with that? Good job, guys. Thank you. I do want to do one thing. It's scenario 2. It's, I think, the last page of your handout. I hope.
Yeah.
Did it make it there? I'll have scenario 1 done and posted with the notes today if you want to do that for practice. So this is the final thing for tonight. A firm with a cost of capital of 10% is working, considering on a new computer-aided design system that costs $360,000 and will produce net cash flows of $149,850 at the end of each year for the next 3 years. The discount factor is what? Again, I'm trying to get practice with the terminology here. So I'm on question 1. What's the discount factor? Sean, what's my discount factor for this problem? $2.402. Is Sean right, guys?
That's what I got.
Is that cool? Row 3, column 10.
I,
On the
That's-
annuity table?
It should be on the annuity table.
that's 2.48685. For
2.4.
for that 10%.
See, wait a second, 6.
Yep, 24868.
He went to the 12%.
Yeah.
Oh yeah, he did. Sean, did you see that? It's, you picked the wrong column. So it's 2487, huh? Is that right?
Yeah. 2, 4.
It's an annuity. What's the internal rate of return though? How do I get that percentage?
Okay,
It's an even cash flow. Well, we could use our calculator, right? Should we do that? All right, let's try our calculator. Again, select CF, second function, clear work. What's our cash outflow in year 0?
360,000.
Very good, Tiffany. Negative, right? Enter that. What's my positive cash flow? 149,
149,
850, right? In 01, cash flow 1. How many years though? 3. So enter the cash flow first. Down arrow, letter F is the years, which should be 3 years. Enter that. Do I have to do anything else? I think I got my outflows, I got my inflows, right? All recorded. Go to IRR and compute. Again, this author has a thing with 12%. So 12%, right? Joe, did your calculator work?
Yep. Yeah, I got, well, 11.99.
That's what I would like you to do for the internal rate of return computations on your test. Now, this is an even cash flow, so I could have done this. Took my 360, divided by my 149,850, gives me my discount factor, which is what?
2.402.
Sean, that's where you were. That'll give us our 12%. Was that what you were trying to tell us? Maybe that's what he was. Oh, you did look at, okay. Thank you for being honest. You could have yelled at me and said, that's what I meant. Okay. The CAD system should be what? Should we do the project?
Yeah.
Yeah. So it should be accepted, right? That's the goal with these models. Because the internal rate of return is greater than the required rate of return of 10%. The 12% is greater than the 12% internal rate of return is greater than the 10% required rate of return. So we should do it. We should accept the project. All right. The rest of these I will somehow get entered through my notes and so forth. You can certainly look at them for practice. Again, if you want to, next week, practice the calculator computations again before you take your exam. You certainly can do that. We will have time next week. Like I said, chapter 15 is not a lengthy chapter because, again, you've done a lot of those ratios in other courses. So chapter 15 should be a review for everybody. So that's what we'll cover next week. Sean, Kayla, any final thoughts? All right. That's it, guys. Have a great night. Thank you, guys.